What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is July 11th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we're going to kick off yet again another Macro Monday here on the DataDash channel. We've got a lot of items to look at today. We're going to be diving into the fade yet again and any strength we're seeing within the crypto market, the upcoming CPI numbers release on Wednesday and what that means for global markets, whether or not equities are in for a relief rally here going into the summer and potentially other assets as well. And outside of that, what could take us from a recession to a depression? We're going to utilize commodities and treasury yields to also try to answer that question. If you guys enjoy the video, consider dropping a like, consider subscribing if you haven't already, and let's go ahead and dive into it. Now, I do want to say, guys, before we kick things off, that if I'm a little bit groggy right now, I was sick back about a couple days to a week ago. Luckily, I did a 3-day fast, and that seemed to really do the trick. I'm feeling a lot better now, and I think I'm on the up and up. So, not fasting advice. Anyways, let's go ahead and kick off the conversation here, starting off with the time frame of the 4-hour for Bitcoin. Now, you all know, if you've watched one of our previous videos, and you've probably heard me mention it through a few previous videos, that the 4-hour time frame is a very significant price time frame that we want to watch for on Bitcoin as we go throughout this bear market. I know a lot of people might think the bottom is in. Either way, we're not here to pick a bottom. We're here to find whether or not Bitcoin can reclaim against certain metrics and indicators that we know a lot of investors are watching that will signal that we have not only stopped treating it as resistance, but we have started treating it as new support. It's very critical to start seeing the bulls take charge over price, taking advantage of the lower price time frames and seeing that there is more demand than available supply in the market. Simply put, well, if we go ahead and take a look at the chart here, as many of you might remember, back here during around July 5th to July 6th, we were waiting to see whether or not Bitcoin can come up towards this range and actually get above it. We were even open to the idea that it possibly could get above there. But again, we're not here to try to pick bottoms. We haven't made any major significant averages yet. And we can see here that we weren't able to get over these two levels, the 200 EMA and the 200 moving average on the 4-hour time frame. These are very critical metrics. And as you can see, as we dive back through time, each and every time we're seeing this range being treated as resistance right before the catalyst for a move downward in price, where the bears take back control. Now, I don't want to say that we're in for an imminent collapse because we haven't been able to get over this range, or we weren't able to retest it the other day. But it's a signal here that we shouldn't be rushing into this as if it's a screaming buy opportunity. Rather, we should take advantage of the strength we've been seeing in the market over the last couple of days to potentially get out of positions. And the altcoin market is a great example of that. The altcoin market has given us a bit of a relief rally here. Whereas Bitcoin and Ethereum are in a bit of a different dynamic here. With derivatives, with leverage, it completely changes the game. And we talked about that a lot in regards to the spike in altcoin dominance that we've been seeing. So what are we going to be watching for here? Well, first off, the first important level that we're going to look for here for potential short-term bounce and maybe a second reattempt here that might be able to get us above here would be the $20,000 range. This is proven, I think, around 4 out of 5 times to be a range where price moves up afterwards. The only time it failed was right here on the 29th of June. And if we get a break below that range, you're at a minimum coming down here towards around 19,600 or potentially breaking lower. And if that happens, you've likely got the momentum to completely collapse down to those previous lows and go even further. And I think that's going to happen if it is going to happen at all during the CPI numbers release. Depends on how equity markets react to it, as we'll talk a little bit about later. Now, on this discussion point here of the 4-hour time frame, the key thing you want to look for, no matter when it happens, I can't draw how it's exactly going to play out here. No one knows how it will look out exactly. Essentially speaking, what I mean is that as these moving averages are generally moving around, we want to see price be able to make it new support over an extended period of time and hopefully start to have these moving averages trending higher here, signaling that price is in an exponentially expansive state, that we are starting to see the bulls take over here, that there is an imbalance of supply and demand that is now favoring getting into the market and setting us up for an entry for a move higher. Again, we don't know exactly how it will play out. I don't want to act like a Nostradamus, but again, that's what we need to see. Another thing as well that I think is important to note is the difference, and this is where more the bear case comes in, that we've got a lower price range to go for Bitcoin's price. Notice back here during the last two attempts, and we'll not even do that, we can even take a look back here at previous bear markets in the past, all the while we don't have all of the price history we need here on the Bitstamp pair. You'll find that if you look back here in January 2015, here in August of 2015, during the bear market of December of 2018, and here in March of 2020, that we either held on the 200 moving average, or when we dipped below there within a week, we were back above those levels. That has not been the case. We have been suspended under this range since the week of June of 2013, and we continue to push practically sideways. This is again why I think it's more practical to expect, especially as we're going to make the argument later on about a depression versus a mere recession, meaning much more pain to come in the next coming year, why we think Bitcoin could possibly come down to this $15,000 range and potentially as low as $14,000, depending on very critical previous resistance ranges of the past, okay? Turning into new support for that matter, right? You might know, if you guys watch the channel for a long time, previous resistance becomes new support, and sometimes when you're at a downtrend, previous support becomes new resistance. It's a very important psychological thing. A lot of people who manage a lot of money use the principles of naked trading. They watch critical key levels and they try to see how price is telling us where the trend wants to go, who is in the lead here. Take a look at Ethereum to BTC. This is another great example here. We could look at Ethereum's dollar chart. Right, that can be valuable, but what's more valuable here in order to determine strength in the market than whether or not Ethereum is outpacing Bitcoin, right? That we may be oversold here. Well, that had been the case here for the past couple of weeks. Since back here on June 13th, nearly a month ago, the ETH to BTC ratio has been generally making higher lows and higher highs here against Bitcoin. And while that's great to see here, as you all know, higher lows and higher highs don't always signal absolutely that price is going to move higher. And the higher lows and higher high principle can be breached when price just happens to go low enough to break the previous lows or that line of support. We've been generally going through an ascending channel here. And what's bad now is that when we actually had the substantial momentum to potentially come up and retest the 0.0625 range here, essentially meaning that you could buy 0.0625 BTC per one coin of ETH, we did not get that. We topped out at the previous level of resistance here. And it would have been fine if we came down here to the 4-hour held and moved higher. That actually would probably be a very good sign. But instead, like last time, we chopped through this range like we have in the past on the BTC pair for its dollar pricing. And now we're starting to roll over again here at this support range, and that could take us all the way back down here to 0.535 on Ethereum and probably give us enough sell side pressure momentum to yet again move lower. A really scary state here potentially for Ethereum. Again, I don't want to speak too soon, but just taking a look at the longer term time frames here, while we had this bounce off the 200 week, an indicator that seems to be holding a little bit more relevancy here is the 200 MA. This was where we had resistance back here in January of 2021, and this would make really good sense for us to come down somewhere around this range here, not only tapping on previous resistance and making it support, but outside of that as well, finding support on the 200 MA. That would give us a clean 50% correction from the all-time highs against, or sorry, not the all-time highs, but the relative highs against Bitcoin from this previous bull market. So as we've had much more cooler gains here against Bitcoin versus the previous bull market in 2017, we would also probably have a bit of a milder correction. Not to mention, Ethereum's got a lot of positive supply side demand economics due to the fact of ETH 2.0. In this case, with staking, with Ethereum being locked in the contract right now, earning yield, and also the migration and all these steps that are going to make Ethereum potentially a much more competitive network, both in its scalability and functionality, but also in its monetary policy, potentially becoming deflationary during the next bull market. We'll have to see. Again, I don't want to speak too soon. Now, as we go into this topic here, around the CPI numbers coming out on Wednesday. I think it's very important to note here that we need to be cautious going into these days. These are days where we do not want to be toying around with leverage. We want to see how the market is going to signal what it's going to do for the next coming days and weeks depending off these numbers. And if we can be patient enough to wait for this, we could really land some great opportunities. And I'll be honest with you all, while we did talk about some of the bearish scenarios here, I gotta come clean with you guys, and I think anyone who is basically worth their salt and being honest with you, they'll tell you that no one really knows what's going to happen after these CPI numbers. Either way, it should be a pretty big move in the market. And the reason why is because this is at a time period here, considering the price action setup we've seen in crypto and equities, and also some of the price moves in commodities and the treasury yields, that we're at a pretty big inflection point here where either the Fed is going to start pivoting or they're going to stick clean to the course here. They're going to continue to hike interest rates, or they're going to start to really mediate here, start raising rates at a slower rate in order to cool down mortgage rates and a lot of the cost of credit throughout the economy in order to avoid excessive delinquencies, right? So let's wait and see what the not per se what the Fed releases, but the U.S. Bureau of Labor Statistics comes out here with on July 13th at 8:30 a.m. Eastern Standard Time. Mark it on your calendars, look out for it, and see how the market reacts. Don't do anything too crazy. Don't try to trade the news. It usually doesn't pay off, guys. I'm only saying that because it holds relevancy for you all to protect yourselves. Now, when it comes to taking a look at equity markets, start off with the NASDAQ 100 here. I think what we have to look for here after the CPI numbers is whether or not we can get above this key resistance range at 12,300 on the NASDAQ 100. If we can get a close above this range, I think we're in for a multi-week rally going into the summer, into sometime in August, back up towards around 13,500 to 13,600. Getting a nice relief rally in those technology companies that have been oversold, a lot of the ARK investment ETF companies, a lot of the poster childs of the March 2020 rally going into 2021, where everything was in this euphoric upward trend. Everyone was a millionaire, or feeling really good about themselves, or feeling like the Wolf of Wall Street. Wall Street Bets was leading the way. You get my point, right? So the major thing here that I really want to emphasize is that if we do get that close above there, which we have not been able to do here for multiple weeks, that is going to be a telltale sign that the market is ready for a nice bump up higher. And again, it's also a trap in many ways. While it may give us some great swing trade opportunities, which if you guys are a part of the Dash report, I'll let you guys know if we do any of those swing trade opportunities in equity markets and also as well in crypto. But outside of that, it's important to note here that as we get this relief rally, a lot of people will go, that's it. We're in for the next bull market. I bought the dip here. I'm going to keep holding my positions. I'm going to keep asking for more returns. And lo and behold, things start to roll over. So don't get yourself caught in a position where if you do open some trades here and it starts to trend higher, that you don't take some profits here, because this range right here that we talked about in today's video is off of the two previous high ranges here back on the 27th of December in 2021 and March 28th of 2022. I would say if you want to hold a little bit, that's fine, but have a trailing stop loss to protect yourself essentially. You'd want to actually see a breakout above this range be turned into support, and I would rate it again towards a higher retest here that would signal that, okay, wow, really, this does seem to be the bottom here. Inflation is cooling down. The Fed is confident in setting up the environment for equities to really start picking up. That's really not the likely scenario, as we'll talk about later on. But again, something to consider here. We don't want to put ourselves into a bubble of certain perspective. Take a look here at the ES1, the E-mini futures, essentially. Again, another critical resistance range. I guess I didn't emphasize that too much here. We can see here this was the point of contestment resistance made as new support that led towards another major move in the NASDAQ, 4,000 points on the NASDAQ 100. This again is another significant range here. All the while, we didn't usually come down to this range and turn it into support. It's where price had coiled here for nearly 2 months. So it is a significant range, and we're doing the exact same thing here. We're trying to get a weekly close above this range. So watch for that this week. And you don't have to exactly wait around until the entire week closes to open trades. Just make sure that we can actually get a daily close above this range and seek out some awesome opportunities. And that could lead the S&P 500 again to come up here towards around 43.40. You pick some individual stocks that have been leaders in the market, make some great returns on those trades. But again, get in and get out quick. That's the mantra that I'm following if I'm doing any of these trades. Now, we got to dive into the big topic of discussion. I want to come back here for a moment. We need to discuss what could take us from a recession to a depression. Now, I understand, you guys, that there's a lot of different perspectives here. And what I'm about to talk about has a bit of a controversial take to some degree. I don't mean to be political or to, opinionated by any degree, but we need to talk about the elements of supply and demand and how the major policies we made over the past few years have completely disrupted many industries, not only leaving them where they had to be shut down for a long period of time, but also making some very rash decisions that could have put them into essentially a corner where there's no way out unless we go through an extensive period of bankruptcy and restructuring. And that's something that no matter what is going to happen for a whole range of industries here coming into the next few years. We don't know about all of them, but we do know of two serious cases where this is a likely scenario, a growingly likely scenario for the next coming months to the next year. And these could be the initial dominoes. Major employers, huge contributors to GDP that could start to knock down the overall economy, consumer sentiment, and lead us in towards a typical 40-50% correction. Today we're going to be talking about the two major things that could push us into a depression versus a recession. Let's go ahead and take a look here at the first topic, airlines. Now, we sent some alerts out about this to the Dash Report group, but essentially we focused in on the fact that not only a lot of these companies, if you look at their stock charts, were on a general decline, as the airlines essentially just became a less attractive asset group, but the major thing is that the airlines, as we went through the pandemic in 2020, were one of the most hard-hit industries. They got a lot of financing and a lot of debt that allowed them to continue operating as planned. And yes, the airplanes and all the assets don't just evaporate, not to mention there's not really anyone to sell it to. So it's not to say that these companies and their assets and the ability to fly is going to be completely disrupted long term. But we need to talk about the health of these companies and the necessary restructuring that they're probably going to have to go through. Now, if the stock price doesn't tell you enough that these companies are in trouble, right? We'll take a look here, for example, at American Airlines. Its standard stock price, if you look at it against the M2 money supply, we're already in previous recession territory here. We're about to enter into the later stages here of recession territory. Delta Airlines, similar situation, back down towards really the March lows. Southwest Airlines, a little bit stronger than most of the airlines, but again, after having a lot more gains here in price, and looks like again with a lower high here, back revisiting down after this correction towards the range here from March of 2020. All right, all these airlines are essentially facing a lot of pain here. Same goes for United and a whole range of other companies. Why is this the case? Well, I want to go ahead and dive into something that a lot of people tend to not look at here. We tend to just look at price. And to be honest, price does tell you a lot here, as we emphasized earlier. But if we take a look at the financials, we're going to see here what's going on with the airlines. American Airlines is a great example here. Did about $42 to $45 billion of annual revenue from 2017 to 2019 on average. If we take a look at the quarterly basis after the shutdown, right? The annual revenue dropped by more than 50% here during these years, a huge hit to the airlines. And it's been slowly but steadily creeping back up. Problem is that as we've been seeing this expansion in revenue, we've now started to see a bit of stagnation here within the growth, essentially hovering around this $9 billion range here with heavily declining profit margins, losing money. Now, it would be one thing if the airlines were just losing some money now. The biggest issue is that there has been a huge difference and change from the balance between their assets and their liabilities. This is general accounting 101 when it comes to the kind of solvency or the financial creditworthiness, the stability, the ability to last long-term as a company. These are the kind of things we would want to see. Well, one really cool thing, and I'll just show you guys just to emphasize it here. If you go on TradingView and look at any company, you can dive into their financials here. They've done a better job, I think, than practically any tools out there, and it's readily available here. How great is that? We can take a look here at their statements. And not only can we see their total revenue and net income as they've dropped and back into losing money here over the past few years, pretty expected after all that went on, but we also have a balance sheet crisis here where their assets, albeit they are slightly expanding here, their liabilities have started to expand beyond their assets. And as you can see here during the past, there would be a much greater net balance between these two throughout most years. But as we entered into the pandemic and into the restrictive policies around that, we started to see essentially the assets get squandered by the liabilities. And the longer this goes on, essentially the longer that these companies lose money, it is going to be detrimental to the airline industry and likely force it into a position where it can't cater to all of its short-term and medium-term liabilities and therefore need to go through a restructuring. Probably meaning layoffs, probably meaning a cut to operations, probably meaning some kind of restructuring, or at least a scare or spook to investors. And that's, unfortunately, out of all of them, the latter is what I really think is going to push equity markets into a domino effect. Essentially, if we didn't have enough to worry about already with supply chain issues and runaway inflation, this could be the first catalyst that could start to knock the markets down. And I gotta tell you all, there's another underlying issue here, and I don't mean to again be controversial about it, but when the airlines decided back during 2021, when the vaccines came out into the market to start mandating that, this created a major issue where airline pilots who didn't want to get the vaccine essentially were forced either into being fired or early retirement, right? You either had to get it or you had to essentially take early retirement and be on your way. And unfortunately, as many people did take that, they've stepped into retirement and they're not looking back. As the airline companies and many corporations who rushed into this, I think, misaligned policy, I think it was a bad decision, as they started to reinstate the normal policies and offer rehiring packages and bonuses for those pilots, many of them aren't coming back. And this has created a very weird dynamic. All the while, demand for flights are much lower than where they were before. For the increase back in the demand for flying, there just simply isn't enough supply of pilots. And that has been a huge contributing factor. Even the CEO of United stated this, that this is why the airline companies are having such difficulties during the traveling back on the 4th of July and a lot of the traveling season. So it is an important thing to note here. And again, you don't need me to tell you it. You don't have to agree or disagree exactly with me. Simply take a look at the financials or the stock price. It will tell the entire story for you. It was a mismanagement on the company's part. And to be honest, I think that they thought that supply, or sorry, better yet, demand would never get back to those original levels, that it was good to get those pilots into early retirement. But it turns out they put themselves in a corner. And this is again going to likely, as we've already seen here with the price decline, take us down to cratered lows where either they are going to be on the verge of a major bankruptcy or restructuring period, or they're going to barely be able to escape it here. Either way, it means lower prices here for some multi-billion-dollar companies. And that is going to weigh down the performance of the S&P 500 and of the broader stock market. Let's go ahead and take a look at the next one here. Cruise lines, another major business sector, billions of dollars in market cap here, all of which are starting to look terrible. I want to emphasize again, we're taking a look here on most of these charts at the 3-month time frame, meaning that we're seeing really long-term performance here going over years of price action. Cruise lines got a nice rebound during the pandemic after the injection of quantitative easing, and yet again rolled over here on a quarter-by-quarter basis down here towards around the same range we were at the lows. And it looks like we're ready to go even lower here for Norwegian Cruise Lines. Let's take a look here. Royal Caribbean as well. Same exact picture here. Back, reversing nearly a decade's worth of gains here, not to mention if you factor in for the increase in the money supply, that's a total mess. And Carnival Corporation absolutely abysmal, down towards a price not seen since the pandemic or since 1993. Cruise lines have never been a least attractive business model than they are now. And the reason why, just like airlines, they got packed on with a ton of debt. Not being able to operate soundly for about a year to 2 years, this has put them in a serious position of financial insolvency. If we take a look here at the financials, we'll scroll down, we can see doing about $5 to $6 billion before the pandemic, coming in here towards just a matter of a little over $1 billion to just over a little half of $1 billion here in last year's financials, losing billions of dollars in the process. Look at those profit margins in the negative. Now, we can see here that perhaps maybe when we dive into the quarterly, maybe things are getting better here. They're starting to reopen operations. Still, they are riding margins here essentially that are negative 188% last quarter. And all the while, these are major leaps and bounds from the previous quarters. Revenue is not expanding fast enough, nor are the expenses, which are putting these cruise lines in the red, are they declining enough? And there's no period of time here within the next year or two where these companies are going to be profitable. Case in point, consumer spending is going down. No one's taking trips as much as they were back in 2021, right? People are not looking to go on a cruise ship right now. And this is, again, where tens of thousands of people, if not hundreds of thousands of people, are employed. It is a huge part of the travel sector, and yet again could be another domino for bankruptcy and restructuring. Again, pushing the performance of asset markets down. Now, they don't really put in the scare here until they make their final move, and that's when you're going to start to see it potentially way down when you get into those late stages of fear within the industry. Now, if all these things weren't enough, guys, again, we need to talk about the final two topics here, commodities and treasury yields. And I want to start off here with the conversation point of mortgage rates. Now, the reason why I want to bring this up, you guys probably remember this chart here. We discussed this back, I think, during the last Macro Monday. And this was a chart that a lot of you really liked here, showcasing the rapid expansion here, what might be a generational bottom in mortgage rates from here in December of 2020 all the way here towards June of 2022. Now, I do want to point out here and be fair, we have started to see what might be the top in mortgage rates. We might see a cool down here, especially if the Fed starts to backtrack on its talking points of raising rates. But the critical thing I need you all to understand here is that no matter if it just held here at 5% or here around this range of the all-time high here at 5.8%, these mortgage rates are deadly to the U.S. consumer. They have essentially increased the cost of borrowing capital to buy a home by over 119 to around 100% here, give or take. And when we understand what that means, that essentially means that whatever you would pay, like I think there was a really good metaphor, kind of explainer for this, like essentially what you'd have to pay, what kind of income you would need to buy let me think about how to say this right. If you had, for example, the income that would allow you to buy like a $500,000 home or take out a mortgage on a $500,000 home, you would essentially need to have double the income now, or around 50% more income, to be able to go out and buy that exact same property, considering the compounding effect of mortgage rates. All right. So again, I don't want you all to take me at my word there. Sometimes I can be bad with math on the spot, but you get my point here. You're going to need much more income to buy those exact same properties, those overly inflated, high-cost properties that everyone thought was just going to go up. Because for years, people could borrow at 2%, essentially making it easy money and what felt like guaranteed money. When in reality, when those mortgage rates kick up and there's no longer enough buyers who have the income to buy those homes, let alone the fact that a lot of companies are laying off their staff, we're seeing those early signs of a recession, that is going to be an extended domino effect on hitting the housing market, all right? Now, if the Fed starts to reverse here and starts to dramatically signal that it's lowering interest rates, mortgage rates could come down here into the 4-3% range, and, perhaps the housing sector won't take such a hit. But I think we're already starting to see the effects. U.S. pending home sales year over year here, down nearly about 15 to 16% here. Not a pretty picture. We can also take a look as well at another really interesting indicator here that I don't think many people focus on, the United States average mortgage size. This is really interesting. So a lot of people, when they're taking out a mortgage, essentially are borrowing a large portion of what they're going to utilize in order to purchase the property. But as mortgage rates are going higher here, this means that people are going to be taking out smaller mortgages, or better yet, they're going to be buying cheaper properties, downsizing a bit. There are some people who are always going to be buying no matter what, and they'll make it work. Essentially speaking, that a lot of the overvalued properties that are just too far out of people's windows that might have been affordable back about a year or two ago are no longer going to be in the buying capacity for everyday citizens. And this number is going to continue to decline here. This was back in around February to March when we peaked at around $450,000. That has now already declined to $405,000, and it will continue to decline here, likely back into the $350,000 range for the amount of money people are actually taking out a mortgage. That should be expected at a minimum. So, very important statistics, leading indicators here that the housing market is likely starting to cool down. Now, when we go into this conversation about whether or not it's going to get worse, we need to look no further than two major market metrics here: the US 30-year yield and oil. Let's go ahead and talk about these. Now, if the Federal Reserve sees that commodity-based inflation is starting to wane here, and that they've been able to cool demand enough in the market where we can see a long-term decline in the cost of crude oil and natural gas, or at least keep it at current levels and wait for incomes to expand, which will take time, they may start to reverse their emphasis on hiking rates. And we will see that reflect here within the US 30-year yield as well as other treasury yields. Essentially what you would want to see here is you'd want to see a head and shoulders pattern where we start to decline down and break down below some key metrics like the 200 EMA. There are many other metrics you could look for, but look for a variety of signs here before getting too confident that the worst is beyond us. If, on the other hand, we start to expand higher and continue higher lows and higher highs and start to again build up the momentum and the kind of breakouts here that signal that the Fed is not cooling down, that inflation, or the cost of commodities essentially here, which have really been contributing, aren't under control, then we don't want to rush into anything. Especially we don't want to rush into buying cryptocurrencies or equities. I know we love crypto. I know we might love some of those companies in the equity markets. We might think they're at great fundamental discounts. It doesn't matter. Are there going to be more buyers or more sellers? And there will be more sellers than buyers if this yield continues to spike higher over the next preceding weeks and months. And that is going to cripple asset markets. It is going to cripple those airline and cruise line companies even further by increasing the base cost of capital in the economy. It is going to force more industries that we don't even know about right now, that might have skeletons in their closets, to come out and have to face a major restructuring, major layoffs, causing again that domino effect to just accelerate in the economy. I don't mean to be too much of a pessimist, guys. I'm in the long term a bullish person. I like to buy into dips and opportunities, and I like to ride major cycles. What I don't like doing is trying to catch a falling knife, because especially if you're toying with leverage, for example, you can not only end up losing a lot of money, you can end up losing it all. And that leads us to the final chart here, and that is oil. Now we need to see that oil is going to treat this previous support range as new resistance. And we have gotten a bit of a rollover, an engulfing candle on the previous daily gains, but we would really like this to continue here down lower. If we find our way back into this wedge here, pressing up against resistance, I think that's your early warning sign that we have not cooled down demand enough yet, that we need the Federal Reserve to continue rising interest rates. And unfortunately, whether the Fed states it or not, put it into their inevitable goal of putting the economy into a recession. It's not fun to talk about it. It's not something that's great to look forward to. I don't want to see people unemployed. I don't want to see the economy slow down. But the fact of the matter is that recessions need to happen from time to time. It's part and parcel here with the way the monetary system works. And unless we are prepared to understand that the Fed not only will go through extreme lengths to keep the economy going, but also as well will go to extreme lengths to cool inflation, we're going to be caught 2 steps behind. And it could end up leaving us in a position where we're worse off than where we were just a couple months ago after already getting hit by the decline that we had to face here within our given asset positions in crypto or equities. We have to understand this, guys, plain and simple here. Bear markets can be much longer and drawn out than many people intend, and what might seem like the recovery here may just end up being a dead cat bounce, like we've seen throughout previous recessions in the past. Keep an open mind, be cautious, and protect your capital. Plain and simple. Money is harder to come by nowadays, not just in the actual physical economy, but through the creation of credit. Not as much credit is getting created, and therefore the dollar is in demand, especially US dollars. Look no further than the Dixie here. In just the past month, we've seen the dollar index go from 102 to 107.5. One of the most fast and accelerative moves we've seen in the past decade. And it looks like it's going even higher. This isn't the period of time for assets. It's a period of time where the global economy is looking for stability, where some countries are going through major supply shortages. And all the while, it will get better eventually. While there will be greener pastures, we have to be prepared for the worst. So that's it for today's video, everyone. Thank you all so much for watching. Again, if you liked the video, drop a like. And whether or not you agree or disagree with me, guys, and all my talking points, feel free to leave a comment down below. Get a discussion going here. I think it's a really exciting time overall. We have to see whether or not the economy is going to be able to turn around here, if the Fed has been able to actually get things under control. I wish for nothing but the best here. I hope that I'm wrong on that more bearish perspective. But it's always best, I've learned over the past decade in my time in financial markets, to prepare for the worst. And I'm going to do my best here to keep you guys as safe as possible here. Sharing my guidance, take it with a grain of salt, listen to other voices out there, and make sure to trade smart. And I'll see you all in the next video. Take care, everyone.